Your simple start. Investing can feel complicated. Enter ETFs, exchange-traded funds. ETFs make investing easier for everyone. So what is an ETF? Let's break it down. Exchange-traded means it's bought and sold on a stock exchange like a regular stock. Fund means it holds a collection of investments. Think of it as a basket holding various assets like stocks or bonds. Imagine grocery shopping. Instead of buying each item separately, you buy a basket filled with diverse items. This helps spread out your money. The main idea behind ETFs is to simplify investing and make it accessible for regular people with low entry costs. It trades like a stock, meaning its price can go up or down during the trading day. ETFs are a smart way to start investing. They offer diversification and simplicity, so whether you're new to investing or looking for an easier way, ETFs could be your answer. The inside scoop. How do ETFs operate? It might sound complex, but it's straightforward. Big financial firms called authorized participants, APs, create new ETF shares. They gather the underlying assets like stocks or bonds and deliver them to the ETF provider. In return, they get a block of ETF shares. APs can also redeem ETF shares, giving them back to the provider for the underlying assets. This creation and redemption process keeps the ETF's market price close to its actual value. If the ETF price strays, APs step in to buy or sell, pushing the price back in line. This is called arbitrage. When you buy an ETF share, you're buying a small piece of a big basket of investments. You own a share of the fund which owns the individual stocks or bonds. This gives you exposure to their performance. Many ETFs, especially index ETFs, are passively managed. This means they try to copy a specific market index like the S&P 500. This passive approach keeps costs low, and low costs are your friend in investing. Remember, understanding how ETFs work can help you make better investment decisions. Different kinds of ETFs to know. Not all ETFs are the same. There are many types, like flavors in an ice cream shop. Understanding the main types helps you choose what's right for you. First, we have index ETFs. An index ETF mirrors a specific market index. For example, an S&P 500 ETF holds stocks of the 500 largest US companies. Next are bond ETFs. Bond ETFs invest in bonds like government or corporate bonds. They can provide a steady stream of income. Then there are sector ETFs and thematic ETFs. Sector ETFs focus on specific industries like technology or healthcare. Thematic ETFs focus on trends or ideas like clean energy or artificial intelligence. These can be exciting but riskier due to less diversification. Choosing the right ETF depends on your goals and risk tolerance. Research and understand what each ETF offers. Diversification is key to managing risk. ETFs offer flexibility and diversification. Why should I even bother with ETFs? The good stuff. Why choose ETFs? There are several strong reasons. First, diversification. One ETF share can give you a piece of hundreds, even thousands of companies. This spreads out your risk. If one company does poorly, it has less impact on your overall investment. Another huge benefit is low cost. ETFs generally have much lower expense ratios than traditional mutual funds. Lower fees mean more of your money stays invested. Over many years, even a small difference in fees can add up to a lot of money. Transparency is another plus. With most ETFs, you can see exactly what investments it holds every day. This is not always the case with mutual funds. Knowing what you own is empowering, and then there is liquidity. Because ETFs trade on an exchange like stocks, you can buy or sell them throughout the trading day at the current market price. This gives you flexibility. Finally, ETFs can be very tax efficient. They often have fewer taxable events compared to mutual funds. This can save you money on taxes. ETFs offer many benefits that make them an attractive investment option. Consider them as part of your investment strategy. Hold on now. What are the risks with ETFs? Be smart. No investment is risk-free. ETFs are great tools, but they come with risks. The biggest risk is market risk. If the stocks or bonds held by your ETF lose value, the price of your ETF will likely go down too. Another thing to watch out for is tracking error. An index ETF aims to match the performance of its underlying index, but sometimes there's a small difference. The ETF might do slightly better or worse than the index. Be very careful with certain types of ETFs, like leveraged or inverse ETFs. These are complex products designed for sophisticated traders, not for long-term investors or beginners. Lastly, there can be liquidity risk, especially for very niche or thinly traded ETFs. Liquidity means how easily you can buy or sell an ETF without affecting its price. Understanding the risks helps you make better investment decisions. Getting started, your first steps into the ETF world. You've learned a lot about ETFs. So how do you actually buy an ETF? First, you need a brokerage account. This account allows you to buy and sell investments like stocks and ETFs. Many reputable firms offer these accounts, and you can often open one online. Once you have your brokerage account, how do you choose an ETF? Think about your financial goals and risk tolerance. Are you saving for retirement or a short-term goal? Research ETFs that match your goals and risk level. Look at what they hold and their expense ratio. Keep it low. A smart way to invest, especially for beginners, is dollar cost averaging. This means investing a fixed amount of money regularly, regardless of market conditions. When prices are high, you buy fewer shares. When prices are low, you buy more. This can smooth out your average cost over time. Start small. Read, ask questions, and get started. A small amount invested regularly can grow significantly over time. Don't get scared by short-term market noise. Be patient and disciplined. Wrapping it all up. ETFs in a nutshell for you. So, there you have it, ETFs demystified. Let's quickly recap the most important points. Exchange-traded funds, or ETFs, are investment funds that trade on stock exchanges like individual stocks. They hold a basket of assets like stocks or bonds. Think of them as a simple way to own a diversified portfolio in one package. We talked about the benefits of ETFs. Diversification spreads your risk across many investments. Low costs mean more of your money works for you. Transparency lets you know what you own. Liquidity allows you to buy and sell easily during market hours. These make ETFs attractive for many investors. Of course, we also discussed the risks. Market risk is always there. The value of your ETFs can go down. Tracking error can occur. Be careful with complex ETFs like leveraged or inverse ones. Always do your own research. Understand what you are investing in. Never invest in something you don't understand. ETFs can be a fantastic tool for building long-term wealth. They make investing more accessible, affordable, and understandable. You have the power to build a secure financial future, and ETFs can be a part of that plan. Follow Plain Talk Finance for more.